Surety insurance. Ever heard of it? If you haven't, you're not alone. It's one of the most misunderstood yet vital parts of the insurance world. So let's break it down. At its core, surety insurance isn't like traditional insurance. It's not about protecting the policyholder from loss, it's about guaranteeing performance. Think of it as a three-party agreement, not two. Here's how it works. The principal, the person or business that's promising to do something. The obligé, the entity requiring that promise like a government agency or project owner. The surety, the insurance company that backs the promise, guaranteeing the principal will deliver. So what happens if the principal fails? The surety steps in, either by paying the obligé for the damages or by finding another way to complete the work. But here's the key difference. The surety can seek reimbursement from the principal. It's a form of credit, not coverage. Let's walk through an example. A construction firm wins a $5 million government contract to build a bridge. The government agency, the obligé, requires the firm, the principal, to secure a performance bond from a surety insurer. That bond guarantees that the firm will complete the bridge per contract terms. If the construction firm fails to finish, the surety may pay to have the project completed, but will recoup losses from the firm later. Underwriting for surety insurance is unique. It's less about evaluating the probability of a claim, and more about assessing the financial strength, track record, and management of the principal. Surety underwriters often review balance sheets and working capital backlog and project pipeline experience with similar project size and scope, credit history and legal disputes. They're effectively extending a form of financial guarantee. That's why principals often need a clean financial record and well-documented business practices to qualify. Now let's talk about claims. Surety claims aren't like typical P&C insurance claims. They usually involve complex legal processes, disputes between the principal and obligé, and sometimes even bankruptcy or contractor default. Before paying, the surety often investigates deeply. Was there a legitimate breach? Did the obligé contribute to the failure? Were contract terms followed? The claims process can include negotiating settlements, finding replacement contractors, or arranging joint completion agreements. And yes, surety losses are often recoverable from the principal or its indemnitors, such as executives or shareholders who personally guaranteed the bond. So, who uses surety insurance? Construction companies, performance and payment bonds for government and private jobs, importers, exporters, customs bonds for international trade, auto dealers, license and permit bonds required to operate, court systems, judicial and probate bonds in civil proceedings, energy and infrastructure, massive projects needing long-term guarantees of delivery. Now, what does the future of surety look like? Surety is evolving slowly, but digitization and analytics are catching up. Startups and tech-forward carriers are developing digital underwriting tools, allowing faster approvals for small bonds. Construction technology and contract analytics could also shape underwriting decisions more accurately. And as infrastructure investment surges worldwide, demand for performance guarantees will rise, driving steady growth in surety markets. But challenges remain. The industry is still manual and paperwork heavy, and losses can spike in economic downturns when project defaults rise. Inflation and labor shortages can also impact project timelines, which can trigger surety claims unexpectedly. To sum it up, surety insurance isn't your everyday coverage. It's about trust, reputation, and performance. It plays a critical role in ensuring that large-scale contracts, infrastructure projects, and regulated industries run smoothly and stay accountable. If you're looking to learn more about niche but powerful sectors of the insurance industry, don't forget to like, subscribe, and follow Insur Knowledge for more explainers like this one.